Hello, everyone. Monte here, market analyst at IG. We are live from Dubai, live from IG's very own office in the UAE. We got ourselves, hopefully, what is going to be some market impacting data, especially when it comes to GPUSD, in about 5 minutes' time. As always, I got my colleague Faizan with me. Faizan, what can we expect from today's readings?
Hello, everyone. Yeah, thank you for tuning in. The UK CPI data, very important for the GBP. And if we look at our previous consumer price index data from September, the month-on-month was 0.5%. Consumer price index for the year-on-year was 10.1%. And the core consumer price index year-on-year was 6.5%. So that was the previous. The forecast for October, we're seeing a 1.7%, and for the month-on-month, year-on-year 10.6%, still rising, and for the core price index for October 6.4%. What are we seeing, Monty?
Yeah,
What do
I
you
know,
think?
especially 10.6%. That's usually one that's going to get people to be a bit more frightful. That's usually the headline figure that takes all the attention. We did get US CPI last Thursday, impacted pretty much everything. This time around, though, we're looking at something that's a bit more focused when it comes to the UK. And 10.6%, I think the year-on-year consumer price index reading, that's the one that everyone's going to look at from a headline standpoint. But here's the thing. From a core, when you take away food and energy, usually the stickier part is what we call the core consumer price index, and expectations are that it's actually going to drop from 6.5 to 6.4%. Let's see if that'll be the case, but either way, I know a lot of you we're still in the shadow of what we saw last Thursday, where pretty much everything got impacted by the US CPI because of expectations of what the US Federal Reserve is going to do. This time around has to do with what the Bank of England's expectations are going to be. So that's when it comes to readings. Just going to take a quick look in terms of what happened last time around. We can see that this is for September. So this was released in October, but it was for September. At that time, we had month-on-month increase of 0.5%, and the year-on-year, it came in at 10.1%, slightly above 10% expectations. The core as well was slightly above expectations. This is what happened when it released. You see the arrow right over there. You saw pound sort of go down, and this is a 1-hour chart, by the way. Sort of managed to recover the day after. We did have plenty of other things happening at the time. Also got, this is what happened in September when we got the readings for August. Year-on-year was 9.9%, slightly below estimates this time around, and you can see initially went down, and afterwards sort of came back up and recovered. So you can't always look at this and think to yourself, oh, we're in for some big trend move that's going to stick for a long period of time, or something as monumental as we saw last Thursday. And just one last one, we're going to go ahead and see the one that was released in August. You can see over here, this is the one where expectations were 9.8%, but it jumped from 9.4 to 10.1, and when the core, the expectation was 5.9. There was a big jump in this case. Did see some bit of a move in this case, about 20 pips of one direction. Afterwards, sort of saw oscillations the other. So not necessarily, you shouldn't go ahead and look at this and think, oh, US CPI, there was this big, massive move. Yeah. I can trade a big breakout strategy. Hold on a second. It really is going to depend first off on where results are relative to expectations, and also given the fact that we're looking specifically at the pound.
So while we wait for the data, we still got 2 minutes for the data to come in. Where have traders positioned themselves prior to the CPI data for the GBP USD, maybe?
Yeah, well, in this case, we're going to take a look at what we see when it comes to today's report that's released. This is the daily market report. Last time we had a look at the weekly, where it was weekly time frames, weekly sentiment changes. In this case, you can see retail sentiment still slight sell, 52%. We've actually plotted it onto the chart, that blue dotted line as percent long. So, back in the day, they were holding extreme buy-buys when prices dipped. They held on. You had a few longs come in. Prices sort of managed to recover and come back up. And we've seen as a result that retail sentiment has been, you can say, mostly close to the middle, and they're going in with a slight sell, 52%. COT speculators, they've been holding a heavier sell bias, and they did pull back a little bit to 68%. This is as of last week, though. They released Friday night. This week it was released a bit late just because we had the Veterans Day last Friday, but that's the situation that we get over there. So they're going in, both of them majority short. I wouldn't say retail trader bias is really heavy to one side or another, pretty much near the middle. It's not going to take much for them to shift to majority buy. And in terms of technicals, for now, you can say that this lift off the lows from a daily time frame, and I'm just going to go ahead and pull up the platforms. You can see that there has been a nice recovery off of the lows that we saw when things were monetary and fiscal policy divergence back then. But if you sort of scroll back a little bit, and this is basically the same as taking out to the weekly time frame, you can see that it's got a lot of lost territory to claw back. And this has really been the story for a lot of the FX majors, and pretty much a lot of the FX pairs against that of the US dollar, because it's pretty much been a dollar denominated story, with the exception, of course, when things got bit volatile on the pound during that period of time. And what we'll do is, just for maximum effect, let's go ahead and zoom into the 1 hour time frame. and just ahead of the release. And basically, for those of you that want to set up, I'm just going to take it briefly back to the technicals. Look, technicals aren't going to matter as much in the face of a fundamental event. You've heard this before. You're going to hear it again a lot of times, that because this is going to impact what the central bank is going to be doing. So what that means is, from a technical standpoint, they usually are going to be a little less relevant. Market makers usually pull out. They're not going to want to hold a lot of liquidity at what are usually key resistance and support levels. Yesterday, for example, just because of what we saw with the U.S. lighter than expected data, we saw prices go up to its second resistance, come back down. Breakouts relatively outperformed. But just to get back to the
Monte, I'm just going to pause you there for a minute. We do have the UK CPI data in, and for the CPI year on year is 11.1% for October. And if we look at the core CPI year on year, it's still around 6.5%. What do you think?
We're going to go ahead and take this one back. So at the end of the day, look, expectation is 10.6, and we got 11.1%. My goodness, it's never it's not a pretty picture at the end of the day. It does mean that there's a lot that needs to be done, and there's going to be pressure when it comes to to both monetary and fiscal policy, but primarily monetary policy, just because their mandate is price stability. One thing we've done here, by the way, is we're taking a look at created a watch list. You can do this with the IG's trading platform, but interestingly enough, you look at the pound, and it's recommended you do this if whatever currency you're trading. If you're trading the euro, put the euro against all the other FX majors on the watch list, so you can really see the source of where the movement's coming from. What is it that's really weakening or strengthening, as well as the US dollar basket. So we can see that the dollar's been declining for today. It's already been in retreat, but you can see that in this case, the pound is also weakening even more. So we can see that when we're looking at this move, a large part of it has to do with the pound. Again, doesn't mean these moves are going to stick. We showed you what happened last time around on the 1 hour chart. You can still see moves that could eventually be undone, but this is the type of move that we expected so far. And yeah, so
yeah, that's quite hefty. Now, why? I mean, a lot of traders, they follow different data. What's the significance of UK CPI for pound specifically, and why it's so important?
Well, and especially these days, right? I mean, inflation. There's this inflation craze. The headlines really capture inflation just because it's so high and because it's above target. I mean, usually when we talk about CPI, to put things in perspective, we saw you mentioned 11% reading.
Yeah,
usually when we talk about CPI year on year, you're looking at moves of the target for central banks usually around 2%, maximum 3%. They're not really going for. So when you talk 10, 11%, the pressure's really on, and that means that the central banks are going to have to react accordingly. I do think that a lot of traders may not have gone in or may not have taken moves that are expected to stick today, just because we're expecting a fiscal update tomorrow out of the UK government, and that's expected to change or influence forecasts for inflation in the future, which is going to influence the way the Bank of England is going to have to react to those forecasts. So that might be a reason why we might have gotten a little bit of a more muted response in anticipation of that. Again, session's not over yet. A lot can happen. There's still also some impact that expected out of the US, but essentially the real reason why it's so important is because their mandate is price stability, and 11%, whether it's the UK or anywhere else for that matter. I mean, when US CPI was hitting above 8%, that's about 4 times above the Fed's target. So obviously their mandate is they're going to have to try and do something to try and reduce inflation, and indeed that's what they have been doing when it comes to raising rates and monetary tightening.
And so, looking at these measurements, what do you think is the main driving factor? Is it more kind of like a demand pull, or it's like a cost push? Or you think it's just the built-in wage factor that is kicking in and the wage cycle is pushing the CPI values?
Well, it depends on where we are globally, but we did see that post-pandemic, we had that, you had a lot of people had a lot of money to spend. They went and they started to spend a lot more on goods because there was lockdown, so less on services. So we saw this goods inflation, services deflation a little bit. We then saw, I mean, at least I can speak on behalf of the US, where with ISM prices paid, you saw the pricing components for manufacturing for the first time since the start of the pandemic. It actually went into contraction.
Yeah.
Prices on manufacturing, whereas on services it's still growing, and that's this sort of shift that we have from goods to services. So that's a part of it. But when it comes to the eurozone in particular, why is it we're getting such a big increase? And a lot of times you're seeing it in headline, whereas with the eurozone, for example, you've seen that the core is actually a bit lower than that of the US and the UK, and that's because of energy, right? Headline, when we talk about the core, we mentioned that the core is it's the headline minus food and energy. Well, if energy is still expensive and if energy is still a problem, even if prices have been coming down a little bit, like Dutch TTF for the eurozone, one of the key energy contracts there, we have seen that the prices come down a little bit, but they're still very, very much high, and that's going to feed into the whole economy, really. Yeah. Because I mean, let's face it, economic growth requires energy and a lot of it.
So is there still hope for the CPI values to just come down a bit, or central bank can control it with energy levels, maybe if
Well,
it's...
that's going to be up to the government, right? If they come out with if their fiscal update involves the price a ceiling on energy prices, basically preventing them from going higher, that means it's also a question of how long that's going to happen, though, right? Are they going to do it, for example, for a few months up until April, but then beyond that, let it go? So that's why it's so important, because that's going to influence forecasts, and that's going to help keep the energy part of CPI, as well as the other things that it influences over the mid to long term, in check, at least in the short to mid term. So that's the reason why it's going to be quite interesting to note tomorrow as well. And I think that might be one of the reasons why it's relatively steady. I mean, I know we're all expecting a little bit of a larger move today. We intend to do so with like US CPI or even non-farm payrolls to hopefully get a slightly bigger move and then apply strategies and things like that to it.
All right, so I guess that's it. The data has come out, and the UK CPI is at 11.1%, and the forecast was only 10.6% a year on year.
Yep.
So that's a wrap.
Yeah, with that, we're going to keep it short and sweet this time around. Good luck to those of you out there, and thank you so much for watching. Happy takes.